Welcome to the critique. So this analysis, it gives a really sharp breakdown of this quiet resilience we're seeing in precious metals.
Mm-hmm.
Against this backdrop of a U.S. manufacturing sector that's slowing down while the services economy is holding steady.
It's a great setup.
It is. And we can just dive right in. The material is built on a really strong foundation. I mean, you've clearly captured that critical economic dichotomy. And that's really where we want to start building.
Right. Taking it from excellent to, essential.
Exactly.
The framework you've laid out is really robust. I especially like how you've identified those 4 major themes that are driving metal performance. But capturing the complexity, that's the key.
Mm-hmm.
So let's start with your central idea, this concept of the market being in a favorable middle ground.
Okay, yeah. So as I understand it from the notes, the argument is that the economy is, well, it's neither booming enough to kill off inflation fears,
Right.
nor is it collapsing fast enough to just get rid of them. And that creates this perfect zone for sustained gold demand. And, spot gold hovering above $4,000 seems to back up this quiet resilience idea.
It does. And that's the core finding. It's really compelling. But we need to ask, why isn't this more clearly defined?
Oh.
The analysis makes a compelling case for the quiet resilience of metals, but that definition of this favorable middle ground environment, I think it needs more analytical depth to really head off potential counterarguments.
I see. So the weakness, I think, is in how it compares to an actual crisis.
Go on.
The material successfully identifies the dichotomy, not collapsing, not booming, therefore it's favorable. But it's a bit light on the specifics of why this balanced state offers better support for metals than, say, a clearer, sharper crisis.
Which usually gives you that huge safe haven spike.
Exactly. A massive, immediate spike. So if this environment is so favorable for resilience, why isn't the rally accelerating? The vulnerability is that the thesis doesn't fully answer that question.
That is the exact friction point we need to address. So the suggestion for improvement is to reframe the analysis. Explicitly define the risk profile that's inherent in this specific market dichotomy.
Okay.
You have to link this specific type of uncertainty, which is, this sectoral weakness combined with this persistent nagging inflation fear.
Mm-hmm.
You have to link that to the sustained, long-term nature of metal demand. That makes the whole thesis much more precise and, frankly, more defensible. It's not just that the economy is split. It's how that split is affecting the policy response.
Let's elaborate on those scenario dynamics. So the material notes that factory activity has dropped to its lowest point in 4 months.
Right.
Instead of just stating that dichotomy, we need to analyze the impact of the pace of that drop. I think you could explore how a slow bleed in manufacturing, when it's offset by services strength, actually sustains inflation fears for longer than a sudden collapse would.
Exactly. Think about the Fed's reaction function. A sudden, sharp crisis, a true collapse. It forces the Federal Reserve to pivot immediately.
No choice.
They have to cut rates, maybe they do some emergency liquidity, and that triggers a massive, sharp, but potentially
Short-lived.
safe haven spike.
Right, it's a momentary panic move. But the slow bleed, that's totally different.
How so?
Well, the services sector, because it's stronger, it gives the Fed cover. They can stay data-dependent, they can stay hesitant. And this paralysis, this prolonged policy uncertainty, is what keeps inflation sticky.
And that cements gold's role.
It cements gold's role as a necessary, sustained inflation hedge, because investors believe the central bank is either unable or unwilling to act decisively.
That is the very definition of sustained resilience. So you should explore that implication of the still-on but risky environment more deeply.
Okay?
If that services resilience keeps interest rates high or inflation sticky, which you mentioned later in your watch points, this specific scenario, it prevents that massive rate cut rally. Sure, but it sustains high demand because of that constant underlying fear of currency erosion.
I see.
You need to define why this specific brand of slow burn uncertainty is the ideal environment for sustained performance, not just a momentary spike. That makes the whole argument much more robust. You're arguing for duration, not just magnitude.
So the concrete example here isn't just pointing out the manufacturing drop. It's analyzing the policy implication of the rate of that drop.
Yes.
You need to explicitly state that the measured, rather than catastrophic, nature of the slowdown is precisely what prevents a quick fix and prolongs the need for a hedge.
Okay, let's move on from the economic structure to the actual mechanism supporting gold, the monetary factors.
Right.
The material is very comprehensive. You've detailed interest rates and real yields as driver 1, and then dollar and inflation dynamics as driver 4.
And they're both undeniably essential components. I mean, gold is a non-yielding asset, and it's priced in dollars. But as separate drivers, they feel like two different stories running in parallel.
Instead of two parts of one powerful machine?
Yeah, exactly.
That's the critical observation. To maximize the analytical power of the monetary drivers, the material should consolidate the sophisticated relationships between interest rates, real yields, and the US dollar, rather than presenting them as distinct, sort of segmented drivers.
So the weakness here is purely structural, but it really affects the depth of the insight.
It does.
Driver 1 is focused on the cost of holding gold, and driver 4 is focused on the pricing mechanism. Fundamentally, they're intertwined, and treating them separately, it just misses the chance to present this unified mechanism.
A mechanism describing how central bank policy hits gold from both sides.
Right, both the cost of holding, through real yields, and the pricing, through dollar strength. You end up analyzing the symptoms separately instead of diagnosing the entire monetary engine at once.
If that chain reaction is what the market sees instantaneously. So the suggestion is to create a single, integrated analytical category. We could call it something like monetary policy leverage points, you know?
Okay.
Something that explicitly describes this flow. We need to trace it. Fed policy signals. That leads to anticipated yield changes, which then causes a real yield and dollar reaction.
Which creates this combined pressure or support for gold.
Yes. Wait, though. If you merge those, isn't there a risk of just packing too much information into one segment? How do we make sure we don't confuse the reader with too much granular policy detail all at once?
That's a fair concern, but the integration is about the impact, not a deep dive on policy. The impact is always doubled up.
Okay.
When interest rates drop, the real yield, the opportunity cost of holding gold, it falls. Simultaneously, that same policy shift weakens the dollar, which makes gold cheaper for anyone not holding dollars. It's a powerful twin effect, and it's driven by a single policy shift. The synthesis just highlights that leverage.
You already have a fantastic, concrete example you can use for this. The observation that gold surged past $4,200 as hopes of a Fed rate cut grew.
You can use that exact point to illustrate the synthesis. Note that this surge is a reaction to both the anticipated fall in real yields and the anticipated dollar weakness. Show the reader that the market sees this as one unified boost.
And the opposite is just as powerful.
Right.
You can explicitly discuss how stronger economic data or hawkish central banks, as you noted, acts as a unified force. It strengthens the dollar and it raises real yields.
Creating a double pressure point on gold.
A powerful one. It makes it more expensive to hold and more expensive to buy at the same time. By integrating them, you show how policy decisions exert maximum leverage. It gives you analysis more gravitas because you're modeling the full transmission mechanism.
Absolutely. And seeing it as a single policy channel just makes the analysis of gold's vulnerability that much clearer. Let's switch gears entirely now and look at the end of the piece, the section on what to watch going forward.
Okay.
It's incredibly comprehensive. It lists everything from PMIs and non-farm payrolls to technical levels and central bank actions.
It's a great checklist. A necessary one for anyone tracking this market. But a checklist only tells the reader what to monitor. We want your analysis to tell them what it means when those numbers move.
Ah, okay.
So the list of what to watch going forward is highly comprehensive, but integrating these points directly with the major themes and drivers would transform the piece from a simple checklist into a powerful predictive framework.
So the weakness is just simple flow and actionability.
Exactly.
The watch points are just listed in isolation at the end. The audience has to do the work of mentally connecting a data release, like the manufacturing PMI, back to the relevant core driver, like your economic resilience versus weakness theme.
Right, and that separation, it just diminishes the immediate actionability of the whole piece. It forces the reader to do the heavy lifting of connecting future dots back to your current thesis.
Which we should be doing for them.
We should. The suggestion is to restructure that final section to actively analyze what a movement in a specific data point would mean.
Would it validate or negate the core thesis for metals? You're turning passive monitoring into active scenario planning.
Okay, this means framing the data points as if-then scenarios right under the major themes.
Yes.
So for a concrete example, let's go back to that economic resilience versus weakness driver. We can explicitly link the next major data releases to that dichotomy and present it as a conditional scenario. If manufacturing contracts further and services also unexpectedly weaken, that combination shifts the metal story decisively.
And what's the outcome?
Well, it pushes us out of this quiet resilience into an accelerated safe haven panic rally. That would require a higher target price.
And we can't forget the purely technical side.
Right.
Connect the technical chart levels watch point to the broader trend analysis. You note that spot gold is currently around $4,060.
Yeah.
Highlight that if gold starts breaking below the key support level of, say, $4,000. That's a huge psychological line. A break there isn't just a technical reversal. It would confirm the market is rejecting the quiet resilience theme.
So it would suggest that overall economic stability is overriding the safe haven demand.
It would be a complete negation of your core thesis.
That specificity is key. It turns the technical level from just an observation into a thesis validating or negating line in the sand.
And finally, you have to link the dollar strength weakness watch point directly back to that integrated monetary driver we talked about.
The second critique.
Right. To find specific actions. For instance, if the dollar index suddenly and sustainably picks up steam due to global risk aversion, that would hurt gold regardless of moderate yield changes.
Exactly. Every single watch point should become the if condition of a then outcome for your core themes.
This whole approach, it transforms that final section into a practical tool. It tells the reader exactly how to use the information they get next week to manage their positioning based on your original diagnosis.
And that's the difference between great analysis and great prediction.
Yeah. Look, this is fantastic foundational work, and these high-level revisions will solidify the argument substantially. The current analysis gives the reader information. The revised analysis will give them a clear, conditional strategy.
Okay, so to summarize the three major actionable suggestions for this critique, first, sharpen that middle ground thesis. Define the specific risk and inflation profile created by the dichotomy.
And explain why that slow, structural uncertainty is a better long-term driver than a sharp crisis.
Second, synthesize the monetary drivers into a single, unified concept that links real yields and the dollar's combined pressures on gold.
Right.
And third, restructure those watch points into active, predictive scenarios that tie directly back to the initial core themes.
We are genuinely confident that implementing these strategic revisions will elevate the material tremendously. It'll make it not just insightful, but indispensable for your audience. You have a really robust framework here, and we encourage you to make these high-level edits.
We invite you to make those changes and submit the revised analysis back in again for another critique. Until next time.